So now we are going to in-depth analysis of the standard. This is the last standard when it comes to your first group. So in your first group, you are having 6 accounting standards in total, out of which 2 are separate chapters. AS3 cash flow statement, that is as part of your preparation of financial statements. Then AS13 accounting for fixed asset, accounting for investment, that is also covered by another chapter, that is investment accounting. Apart from that, there are 6 accounting standard, and the last one we are discussing on this first group accounting standard is that accounting standard 16 on borrowing cost. We had discussed the core principle of the standard, that is the borrowing cost incurred in connection with acquisition, construction, or production of a qualifying asset that will only be capitalized in the books. Other than that, if there is any borrowing cost, that will be taken to revenue, that will be taken to P&L. This is the core principle of the standard. So out of this, we had learned 2 more aspects. First one, cost of equity. Cost of equity, whether it is actual or imputed, that will not be taken for the purpose of your borrowing cost computation as per the standard. Then another aspect is that borrowing cost. Borrowing cost as per the standard only include interest and other costs incurred by an enterprise in connection with borrowing of funds. So this is not just interest. It is interest and other costs incurred in relation to borrowing. Therefore, borrowing cost is much wider term as compared to the interest. So we will first identify what are the components of borrowing cost. Then we will go to the standard. So if you check the components of borrowing cost, borrowing cost has 5 components. Borrowing cost has 5 components. First one is your interest and commitment charges on bank borrowings and other short-term and long-term borrowings. First one is your interest cost. What you call as interest is covered under borrowing cost as your first component. Second component is that amortization of discount on premium relating to borrowing. Okay, if you check your foundation level, or if you check your +2 accounting and all, you had learned how to account for issue of debentures. In that, if there was any premium or discount, discount at the time of issue or premium at the time of redemption, we will recognize those elements at the beginning of at the time of recording this debentures in the books. And afterwards, what we will be doing is that we will amortize it to the profit and loss account over the period of those debentures. So if any debenture or similar item is provided, there, and there is any discount or premium is there, annual amortization of those type of costs are the second component, that is amortization of discount on issue or premium on redemption relating to borrowings. Then the third component is that amortization of ancillary cost incurred in relation to borrowing. For example, you are taking a loan. For that the loan amount is 1 crore. Sometimes bank may take up processing charges. This is an ancillary cost in relation to that borrowing. All those type of costs will also form part of your borrowing cost. Then fourth component is that finance charges in respect of assets acquired under finance lease or other similar arrangement. We will learn what is a finance lease and how it should be accounted. Then we will see something known as finance charges. It is nothing but when it comes to your hire purchase account, what you will be doing in the books of hire purchaser, you will be recognizing loan. and you will be providing interest on that. Similar to that, when it comes to finance lease also, you will consider that as your asset and you will create a liability. And on that liability, you will provide interest. That component will also form part of your borrowing cost. That's it when it comes to leases. Then, fifth component, exchange differences arising from foreign currency borrowings to the extent regarded as an adjustment to borrowing cost. Okay, that is some part of exchange difference, we will consider it as part of borrowing. Okay, that is the fifth component. Okay, if you check the fifth component, there is an area from which we can expect a question. So we will analyze this fifth component carefully. First four components are routine items. Fifth one is little bit technical. So we will discuss this fifth element, that is exchange difference to the extent considered as an adjustment to borrowing cost. Okay, if you consider this, we'll take an example. There is a company known as A Limited. They want rupees 65 lakhs. They want rupees 65 lakhs on 1/4/2019. Okay, they want 65 lakhs as loan on 1/4/2019. They are having two options. Either they can borrow at 6% from US. Okay, that is, they have to take loan in US dollar. That's interest rate. Interest rate for those type of loan is 6%. Or they have to take 11% interest. They have to pay 11% interest if they are taking from Indian rupee. If the loan is in Indian rupee. If this is the scenario, what this company will do, whether they'll borrow from India or US, they'll usually go for US option because the interest rate is lower there. So they'll go for US option. So as on the date of borrowing, the exchange rate is rupees 65 per US dollar. Okay, exchange rate is 65 per US dollar. Then how much foreign currency they have to borrow? They have to borrow 1 lakh US dollar. Okay, 1 lakh US dollar. Initially, no principal component needs to be repaid. Okay, we'll assume that, and based on that, we will compute the interest and all. So, if you check this item as at year end on 31/3/2020, they have to pay first interest. They have to pay first interest. They had taken loan in foreign currency, that is in US dollar. So interest will also accrue in US dollar. We have to pay them US dollar as interest. So what will be the interest for this whole 1 year? Interest for this 1 year will be 6,000 US dollar. Okay, 6,000 US dollar. You have to pay them 6,000 US dollar. So you will convert Indian currency into foreign currency. So on that date, rupees 70 is your exchange rate. Then how much amount you will pay as your interest? 6,000 US dollar is there. 70 rupees is the interest. So you will pay 4,20,000 as your interest. This is your normal interest and other commitment charges. Next, what we will do is that this is a monetary item. This loan of 1 lakh US dollar is a monetary item. So we have to restate that item. Okay, we have to restate that loan amount. So you had recorded this at 65 as on the date of borrowal. That means you had only accounted 65 lakhs in your books, right? But as at year end, your exchange rate is changed. it is 70 rupees now. Then what we will do, since it is a monetary item, we will restate it to closing rate. Then what should be the liability? 1 lakh US dollar is there, 70 is the exchange rate. So 70 lakhs will be the volume. So you will additionally incur an exchange loss of 5 lakh. Okay, out of this 5 lakh, some amount needs to be considered as borrowing cost. That is what we are going to learn. Okay, so the interest will be paid in foreign currency. Whatever be the foreign currency paid for that will be taken to interest cost alone. While restating your liability, some part of exchange difference we have to consider it as borrowing cost. How we will compute that, which component we need to take it as part of your borrowing cost, that is the thing we are going to learn. So first we will check what is the interest we had saved by taking loans in US dollar. Okay, if we check this, if they had taken loan from India, they were required to pay interest at the rate of 11%. That means interest would have been they would have borrowed 65 lakh rupees, 65 lakhs into 11%. This would have been the interest they would have incurred. So 65 lakhs into 11%, 7 lakh 15,000. Okay, 7 lakh 15,000 they would have incurred as borrowing cost if they had taken loan from India. But what they had did, they had taken loan from US. Therefore, your interest cost is reduced to 4,20,000 exchange difference. Okay, by way of exchange difference in your P&L, you'll be taking 5 lakh additional expenditure. So what the standard states that to the extent of this interest savings, you have to consider it as borrowing cost. Only balance you have to consider it as exchange difference. Okay, so out of this 5 lakh, we will segregate this into adjustment to borrowing cost and exchange difference. Out of this 5 lakh, 2,95,000 is adjustment to borrowing cost, and only 2,05,000 we need to consider it as exchange difference. So your total borrowing cost will be interest and commitment charges. There will be 4,20,000. Exchange difference considered as an adjustment to borrowing cost, you will take 2,95,000. Total your borrowing cost will be 7,15,000. And you will also take exchange difference as per AS11 as 2,05,000. So this is the way in which you will record this in the books. You will record in the books because you had saved 2,95,000 rupees by way of interest, but at the same time, due to this borrowing, you had incurred some loss also. Okay, so to the extent of savings you had made, you have to consider it as an adjustment to borrowing cost. So is it clear? Is it clear whether this treatment is clear? Okay, so the next aspect, so we will do a problem on this. We'll do a problem on this. Okay, this is a question on this. Sun Cooperative Society has borrowed a sum of 12.5 million. Okay, 12.5 million means that is 1.25 crore US dollar. Okay, 12.5 million US dollar at the commencement of financial year 2016-17 for its solar energy project at LIBOR. LIBOR stands for, it is a base rate which is used globally, that is Lenten Interbank Offered Rate. Okay, so this is, the rate is for 1%. LIBOR rate is 1% plus 4% is your interest rate. LIBOR plus 4% is your interest rate. LIBOR is given as 1%. Therefore, your interest rate is 5%. Okay, your interest rate is 5%. This is the meaning. The interest is payable at the end of respective financial year. The loan was availed at then rate of 45. Okay, when this borrowing was taken, then your interest exchange rate was rupees 45 per US dollar, and as at year end, your exchange rate is rupees 48 per US dollar. Okay, had they borrowed rupee equivalent in India, the interest would have been 11%. So if they had borrowed from India, their interest rate would have been 11%. They had borrowed in US dollar, their interest rate is only 5%. This is the situation now. What we are required to do, we are required to compute the borrowing cost and also show the exchange difference as per prevailing accounting standard. Okay, so we have to compute two items. First one, what is the amount of borrowing cost as per the standard? Second one, we have to compute what is the exchange difference we have to consider as per AS 11. Okay, similar situation. So first what we will be doing is that we'll be doing what is the interest cost for this year. So working note number 1, okay, interest for the year. Interest for the year. We check the interest for the year. They had taken loan amount is $12.5 million, and your interest rate is 5%. Therefore, interest in US dollar, okay, that will be 12.5 million into 5%, that is nothing but US dollar 0.625 million. Okay, this is your interest in USD. What you will do is that you will pay this at the year end, that is exchange rate at the date of settlement. We have to consider that exchange rate they had taken as 48. So 48 is your exchange rate. So rupees 48 per US dollar. Therefore, interest cost in rupee, that will be into 48, you will be having rupees 30 million as your interest cost for the year. Interest cost alone, we have not considered the exchange difference considered as borrowing cost. So your interest component is this. Then working note number 2, I am going to compute what is the interest savings we had made. So interest savings we had made, or loan amount in US dollar, okay, is $12.5 million. Okay, exchange rate on availing loan, okay, that was rupees 45 per US dollar. Okay, that was rupees 45 per US dollar. So what is the loan amount in Indian rupee? What is the loan amount in Indian rupee? That will be 12.5 into 45. That is nothing but rupees 562.50 million. Okay, this is your loan amount. Okay, if you had taken loan from India, your loan amount would have been 562.50 million rupees. Okay, if you had taken this borrowing in Indian rupee, you would have paid interest at the rate of 11% on this amount. So your interest in Indian rupees would have been rupees 61.875 million. Okay, but what is the actual interest? Actual interest you had incurred, that is your working note number 1, rupees 30 million US dollar rupees only. So what is the interest savings you are having? Interest savings is rupees 31.875 million. So this is your interest saving. Okay, are you clear with this till now? Are you clear? Is it clear? Okay, we had computed what is the interest, then we had computed what is the interest savings. Now we are going to compute what is the exchange difference. So now we are going to compute what is the exchange difference. So working note number 3, computation of exchange difference. Computation of exchange difference. Okay? If you take exchange difference, your total exchange difference is equal to you had borrowed 12.5 million. At the time of borrowing, your exchange rate was 45 and now it is 48. So your exchange difference will be 12.5 into 3, that is nothing but rupees 37.50 million. Okay, 37.50 million. This is your total exchange difference, out of which to the extent of interest savings, we will consider it as part of borrowing cost. That is, there is working note number 2. So that is rupees 31.875 million. So balance only we will consider it as exchange difference as per AS 11. Exchange difference as per AS 11, that will be rupees 5.625 million. Okay. This will be your exchange difference as per AS 11. Suppose your exchange difference was only 30 lakhs and your interest savings was 31.875, then this entire exchange difference we will take it as part of your in the interest cost, borrowing cost, and no part will be taken to your exchange difference. So what you have to take is that to the extent of whatever is there as exchange difference, we will consider it as part of borrowing cost. So what we'll do is that our main answer, if we take our main answer, we have to take two values. First one is what is your borrowing cost as per borrowing cost as per AS 16. This is nothing but first you are having some interest, okay, rupees in million. First you are having some interest, that is nothing but 30 million rupees, and you are having exchange difference considered as adjustment. Exchange difference considered as adjustment to borrowing cost, that is 31.875 million. Therefore 61.875 million is your borrowing cost. Then your exchange difference as per AS 11 is nothing but this is your exchange difference, that is 5.625 million. Okay, 5.625 million. So if we check this figure we had arrived at in working note number 1. This is working note number 2. This is working note number 3. Okay, so are you clear with this? Are you clear with this concept? Okay. Then another aspect is that there won't be any exchange gain in such instances. We'll only have exchange loss because there is some theory known as interest rate parity theory. That means if your home currency borrowing rate is higher and your foreign currency borrowing rate is going upward. Okay, so your foreign currency borrowing rate is less and your home country interest rate is higher. If this is the situation, which country is having lower interest rate, their currency will get stronger. And the currency in which higher interest rate there is there, that currency will get weaker. That means usually this scenario will arise. You will not get the opposite situation usually. Okay, so this is the situation.
Sir, can you show the working note number 1?
That's it. Okay, we'll continue.
Yes, sir.
Okay, so the next one we are going to discuss about this borrowing cost. I had said that the core principle of the standard is that whatever the borrowing cost that is directly related to acquisition, construction, or production of a qualifying asset, this alone will be capitalized, and other borrowing costs we will take it as a revenue expenditure. We'll take it as just a expenditure, just an expenditure. We cannot capitalize unless it is directly attributable to acquisition, construction, or production of a qualifying asset. So first we have to understand what is the meaning of qualifying asset. Okay, qualifying asset is an asset which necessarily takes a substantial period of time to get ready for its intended use or sale. Okay, qualifying asset is an asset which takes substantial period of time to get ready for its intended use or sale. What it exactly means: if substantial period of time is required to make some asset. If substantial period of time is required to make some asset with usable condition or saleable condition, then only an asset will meet this definition of qualifying asset. In order to qualify something as qualifying asset, in order to meet something in order to meet the definition of qualifying asset, what is the crux? There should be a substantial period of time to get ready for its intended use or sale. In order to bring it to the intended use, intended say purpose, there should be a substantial period of time. Then only it will be considered as your qualifying asset. That means you had booked a car, and you got it in ready to use condition, right? The car you had purchased will be in ready to use condition. This will not meet the definition of qualifying asset because there is no substantial time required to make it ready for use. Okay, when it comes to a motor car, what is the situation is that it is in ready to use condition. So you cannot capitalize the borrowing cost if you had taken loan for purchasing that motor car. We'll take another example. You had taken a loan for building or constructing a building, office building. So what happens in this case is that this construction will take some time. The construction will take some time. Therefore, there will be a substantial period of time to get ready for its intended use. Okay. So likewise, you have to analyze whether any time is required for this asset to make it in a ready to use condition or ready to sale condition. Then only it will meet the definition of qualifying asset. So the substantial period of time, the standard has not given a had not given a guideline in the initial phase, but subsequently they had given a guidance on this. So what they had said is that substantial period of time, it depends on the facts and circumstance of each case. They are not giving any definition for substantial period of time. They are stating that it is based on facts and circumstances of the case, but a period of 12 months or more, okay, a period of 12 months or more will be substantial period of time for most of the enterprises unless a shorter or longer term can be justified based on facts and circumstances. What this means, if the time taken to get ready, okay, if the time taken to get ready for its intended use or sale is 12 months or more, it will always be qualifying asset. It will always be a qualifying asset unless otherwise proved, based on facts and circumstances. Then a period less than 12 months is considered as substantial if the facts and circumstances prove that. For example, we are seeing this corona situation. Okay, this pandemic is going on. At this time, government had borrowed some money and constructed a hospital within 1 month time. Okay, this borrowing cost may be substantial for them. This period may be substantial for them because they had borrowed it in an emergency situation. They wanted to complete the construction at the earliest. So they had arranged the borrowing from the available source and constructed this. So considering the facts and circumstances of this case, thus 1 month, 1.5 months may also be considered as substantial. But usually a 12 months or more is substantial for all type of entities. So are you clear with the definition of qualifying asset? Are you clear with the definition of qualifying asset? you should have a substantial period of time to get ready for its intended use. So this qualifying asset can be an inventory, it can be an intangible asset, it can be a property, plant and equipment. Okay, either of these three items may be a qualifying asset if a substantial period of time is taken for their construction, production or acquisition. This is the case. So this is your qualifying asset. Okay, this is your qualifying asset. So what we will do is that we will take one example. Sorry. Will continue with this. So this is your definition of qualifying asset. So for qualifying asset, what type of borrowing cost you can capitalize? Sometimes we will take specific borrowing in relation to some assets. So that is solely attributable to this asset. Those type of borrowings are your specific borrowing. You can capitalize borrowing cost in case of specific borrowing. The amount we can capitalize is nothing but your actual borrowing cost. Okay, actual borrowing cost incurred on specific borrowing less income earned on temporary investment from borrowing. For example, if you take a construction of building, okay, you had taken 50 lakhs for construction of building. This amount has dispersed to your bank account. Okay, so this amount is lying in your bank account. You had approached a contractor. He had asked you for advance of 10 lakh rupees, and balance amount needs to be paid only upon completion. Okay, so in your bank account balance 40 lakhs will be there. You had taken loan for 50 lakhs. You had paid 10 lakhs to the contractor as an advance, and 40 lakhs remains in your account. It is remaining in your account. So what you are doing is that you know that this building will be completed. The construction of this building will complete by after a 6 months period. So what you are doing is that this 40 lakhs you are going to put in a fixed deposit account, because you are already that loan has dispersed your account. So interest on loan is accruing. Okay, interest cost is being accrued. Okay, if this amount lies in your current account, you will not get any benefit. Okay, so during this time in which this amount is not required, what you are doing is that you are investing that in some temporary setup. Okay, you are going for some temporary investment so that you can reduce the interest burden. Okay, so this interest you had earned on fixed deposit for 6 months. Okay, this is an income earned from this borrowed fund. So what is your expense on borrowed fund less what is the income from temporary investment? That component only you can capitalize. Okay, that component only you can capitalize when it comes to specific borrowing. When it comes to your general borrowing, okay, whether the borrowing cost related to general borrowing can be capitalized. We had learned the core principle that the borrowing cost incurred directly in relation to acquisition, construction or production of a qualifying asset will get capitalized. Whether borrowing cost from general borrowing, for example, we are having a cash credit account, that is your working capital facility, short-term borrowings. Likewise, you are having some borrowings. Whether this borrowing cost also can be capitalized. Whether this borrowing cost also can be capitalized. the standard states that this also can be capitalized. Why? Because if you are not constructing this asset, if you are not producing this assets, this much amount would be surplus for you, right? This amount you could have repaid to bank so that your interest cost would have been lower. That means only because of your constructing this, your interest cost is on a higher side. Therefore, the borrowing cost in relation to general borrowing can also be capitalized considering this fact. That is why the standard permits that the borrowing cost incurred, the amount you had utilized from general borrowings also you can capitalize. So the amount can be capitalized as nothing but the expenditure you had incurred from that, less, sorry, into capitalization rate. Capitalization rate is nothing but your weighted average cost of capital. It is your weighted average cost of capital. This is taken on a pre-tax basis. Okay, we are not adjusting for any tax element, tax savings. What we will be doing is that we'll simply take total interest, we'll simply take total average balance of loan, divide these two, that is interest divided by loan amount, you will get a weighted average cost of capital. That will be considered as your capitalization rate. You will take how much expenditure you had incurred from general borrowing, that into this capitalization rate, that much amount you can capitalize. Okay, but only thing is that the amount you are capitalizing, should not exceed actual borrowing cost. The amount you are capitalizing should not be above, should not exceed the actual borrowing cost. This is your case when it comes to borrowing cost. This is the case when it comes to borrowing cost. So what type of borrowing cost we can capitalize? Are you clear with this? When it comes to specific borrowing, you can capitalize borrowing cost incurred less the contingency of loan. You can capitalize only till some point of time, and you cannot capitalize from the day the loan is taken. There is a starting point for capitalization, there is an ending point for capitalization. That is the next aspect we are going to discuss. So first aspect is commencement of capitalization. Okay, first aspect is commencement of capitalization. Okay, when we should start the capitalization, from that date only we can start capitalization. Whatever be the borrowing cost you had incurred on general borrowing, whatever be the borrowing cost you had incurred on specific borrowing, before this date we cannot capitalize. You have to treat it as a expenditure, revenue expenditure. So this is the crux, that is the point in this guidance. So what is the date of commencement of capitalization? They had given three simple criteria. First one, borrowing cost is being incurred. Okay, we had taken the loan and we are incurring borrowing cost. Okay, second one, expenditure is being incurred. Expenditure is being incurred. Okay, third one, active development in progress. Active development in progress. Okay, you are having three conditions on which date all these three conditions are being satisfied. On which date all these three conditions are being satisfied, that is known as commencement of capitalization. For example, you had taken a loan on 1/4/2019, but construction had started only on 1/5/2019. Then construction you had started, active development has also in progress. So on this date only you can capitalize. Or we'll take another example. You had taken the borrowing, okay? You had taken the borrowing on 1/4/2019. Okay, you had paid some amount to the contractor on 1/5/2019, but this contractor had started the construction on 1/6/2019 only. You can commence capitalization from this date only. Okay? Or in this case, you had given advance to the contractor only on 1/5/2019. Construction started on 1/6/2019, but you had taken a loan only on 1/7/2019. Then on this date only all these three conditions are satisfied. You should take this date as your commencement of capitalization. So they had given a clear-cut instruction to when to capitalize, when to start the capitalization. That is the date on which we had started incurring borrowing costs, we had started incurring expenditure, and the active development is in progress. On which date these three conditions are being satisfied, this is known as this. From this date you can start capitalizing this borrowing cost. We can start capitalizing the borrowing cost. And when we should end the capitalization, that is cessation of capitalization. Okay, cessation of capitalization. This date will be the date on which substantially all activities necessary are complete. Okay, the standard does not states that all activities should be completed. The standard states that all substantial activities are completed. That date you should cease your capitalization. That means you are constructing a building, you had not painted that building. For example, you had the painting work is painting. Other than that, all other thing is done. You should cease your capitalization, because without painting that building also you can use that substantial complete. So need not necessary that all activities should complete. Substantially all activities needs to be completed. Okay, this is the case when it comes to your borrowing cost. We can capitalize on the date in which these three conditions are being satisfied, and you should end capitalization when substantially all activities are complete. And in between some period we cannot capitalize this. This is known as suspension of capitalization. Okay, this is known as suspension of capitalization. That is, you cannot capitalize the borrowing cost on this period. Okay, this is the extended periods in which active development is interrupted. Active development is interrupted. Okay, this is the extended periods in which active development is interrupted. This is your third situation, suspension of capitalization. Okay, for example, we are facing this lockdown scenario. In this period, construction of a building is not being carried out due to lockdown restriction. So during this period, whatever be the interest cost you had incurred, whatever be the borrowing cost you had incurred, you cannot capitalize. So this is the best example we can give for the suspension of capitalization. Some period there is some lockdown, some period the work has not done. In those periods we cannot capitalize the borrowing cost. So that is your suspension of capitalization. So are you clear with these aspects? Are you clear with these aspects? When to start capitalization, when to end capitalization, and at which point we should suspend the capitalization. Are you clear with this? Okay. So what we will do is that we will do one problem, and afterwards we will take a break. Okay, we will take a break, then we will do some more problems on this chapter, then we will be moving on to the second group. Okay, so in May 2016, Speed Limited took a bank loan specifically for construction of a new factory building. Okay, this is a factory building. It will take substantial period of time to get ready for its intended use, because it is a construction activity. Only thing we need to consider is how much is the duration, whether it is substantial for this entity or not. But on a prima facie analysis, this will be a qualifying asset. Remember this thing first. So the construction was completed in January 2017. May 2017 to January 2017, this is the construction period. And this building was also put to use immediately. So they had started using thereafter. Interest on actual amount used for construction of building till its completion was 18 lakhs. Till completed, you had only incurred 18 lakhs as your borrowing cost, but total interest payable to the bank on loan till 31st March 2017 is 25 lakhs. Can 25 lakhs treated as part of cost of factory building and thus capitalized on the plea that loan was specifically taken for construction of factory building? Whether we can capitalize this entire 25 lakhs, this is the question. Whether we can do it, how much amount we can capitalize in this case? How much amount we can capitalize in this case? Respond, please. How much amount we can capitalize? Okay. So while you are answering this question, you should be careful. They had not stated that this is a qualifying asset, and if you take the construction period, it is less than 12 months also. So you have to state the guidance in this standard, and afterwards you have to tell that we are assuming this as a qualifying asset. Then you can capitalize 18 lakhs. You cannot capitalize 25 lakhs. If you are not assuming this as qualifying asset, you cannot capitalize any amount. You have to take this entire 25 lakhs to borrowing cost. So what you will do is that in this case, first you will write as per AS 16 borrowing cost, the borrowing costs incurred directly in relation to acquisition, construction, or production of a qualifying asset can be capitalized as part of cost of asset. As per the standard, qualifying asset means an asset necessarily takes substantial period of time to get ready for its intended use or sale. This substantial period of time is not defined in this act. The standard states that any period of time can be substantial based on facts and circumstances. Generally, a period of 12 months is considered as substantial unless a shorter or longer period can be justified. This is the case when it comes to your borrowing cost. So, in this scenario, what we'll say next? We'll say, assuming in this case, your construction had taken around 8 months time. We will assume that this is substantial for this entity and we can treat it as a qualifying asset. Even though it is a qualifying asset, your capitalization should cease when all necessary activities, substantially all necessary activities are completed. You had learned what is the cessation criteria. Then what is given is that cessation, capitalization of borrowing cost should cease when substantially all activities necessary to prepare the qualifying asset for its intended use or sale are complete. Okay, here this is completed on January 2017, and therefore borrowing cost till its completion, that is 18 lakhs, can only be capitalized, and balance 7 lakhs needs to be taken as revenue expenditure. This is the case when it comes to your borrowing cost, in treatment of borrowing cost in this case. Okay, so this is your first question. The second one we are having, there is a company known as Rainbow Limited. They had borrowed 150 crores on 1/4/2016. This is for construction of a boiler plant. Okay, they are constructing a plant. This is expected to be completed in 4 years. So construction, this will take 4 years. This is an asset which necessarily take substantial period of time to get ready for its intended use. This is a qualifying asset. Okay, this is a qualifying asset. So you had borrowed 11% borrowing. Then the weighted average cost of capital for this entity is 13% per annum. Accountant of Rainbow Limited therefore capitalized 19.50 crores for the accounting year ending on 31/3/2017. Okay. Due to surplus fund out of 150 crores, income of 3.5 crores earned were credited to profit and loss account. Comment on the above treatment of accountant with reference to relevant accounting standard. So what are the things you have to consider in this question? What are the things you have to consider in this question? Respond. What are the errors you can see in this question? What are the errors? Income from temporary investment. Okay, right. Then anything else? Income not reduced. Okay, fine. Then other than this, whether there is any other error? Four years is greater than 12 months, then it's a qualifying asset. Okay, fine. This is another aspect we have considered already. A capitalized amount, what is the issue in that? What is the interest rate 11% is the interest rate, right? They had taken a specific borrowing for construction of this boiler plant, right? They had taken a specific borrowing. What is the amount we can capitalize in case of specific borrowing? Actual borrowing cost less income from temporary investment. This is the amount you should capitalize. But what they had done is that they had considered their weighted average cost of capital of 13 lakhs. They had applied 150 crores into this 13 percentage and arrived at rupees 19.5 crores. This they had capitalized in their books, which is wrong. Okay, when it comes to your specific borrowing, actual borrowing cost needs to be considered. 150 crores into 11 percentage, that is 16.50. 16.50 lakhs crores needs to be considered first. This is the first error. Second error is that income from temporary investment they had taken as income. This is not correct. This needs to be reduced from the borrowing cost we are capitalizing. Okay, this needs to be reduced from the borrowing cost you have to capitalize. Therefore, what is the actual amount you can capitalize? Your capitalized amount should be 150 into 11 percentage, that is equal to 16.50 crores, less income from temporary investment, that is nothing but 3.5 crores. Therefore, you can only capitalize 13 crores, whereas you had capitalized 19.5 crores. Whereas you had capitalized 19.5 crores, which is not in accordance with A16. So you have to state this is a qualifying asset, since it takes a substantial period of time to get ready for its intended use. In this case, we had taken specific borrowing. The amount which we can capitalize when it comes to a specific borrowing is that actual borrowing cost incurred less income from temporary investment. Therefore, we cannot take the weighted average capital when it comes to there is a utilization from specific borrowing. If you had a loan from specific, if you had incurred some expenditure from specific borrowing, then you should consider actual borrowing cost less income from temporary investment, if any. That can only be capitalized. So if you take this case, you had incurred a 50 lakhs, you are having a 20 lakhs a specific borrowing. Our assumption is that first 20 lakhs is utilized out of our specific borrowing, and balance 30 lakhs we had utilized from general borrowing. Likewise, we will allocate, if there is a specific borrowing, we will consider to that extent it is utilized from this. Okay, in excess of your specific borrowing, what is the expenditure you had incurred, that is only considered as your utilization from general borrowing. So this is the case. So this is not a general borrowing, this is a specific borrowing. So actual borrowing cost incurred less temporary investment need to be considered, that is 13 crores, whereas capitalization is 19.5 crores, which is not in accordance with A16. Are you clear with this? Are you clear with this? Okay, so we'll take a short 10 minutes break. Continue. Okay, so next also we'll do some problems on this. We'll do some problems. That is, X Limited began construction of a new plant on 1st of April 2016, and they had obtained a special loan of 8 lakh to finance the construction of plant. Okay, they had begun construction on 1st of April. They have a special loan. This is a specific loan of 8 lakhs to finance the construction. The rate of interest is 10% per annum. The expenditure made on the project of plan was as follows. Okay, so this is your case. So you are having 8 lakhs loan. On 1/4/2016 itself, you had spent 10 lakh. On 1/4/2016, you had again spent 24 lakhs. And on 1/1/2017, you had spent 4 lakhs. Company has other non-specific loan of 46 lakhs. So this is your general borrowing. And for this, they had said that 12% is your interest rate. Construction of this plan was completed on 31/3/2017. That is 1/4/2016 to 31/3/2017. 12 months period. We will consider it as a qualifying asset. You are required to calculate the amount of interest that can be capitalized as per the provisions of AS 16 of the borrowing cost, including cost. So what you have to do is that you should compute total cost of this asset. This much cost you had incurred. Apart from this, how much borrowing cost you can capitalize, and total cost of that asset, what will be the value. So that is the amount you have to compute in this question. So if you consider this, 10 lakhs they had spent in the beginning, and this amount is there for 12 months. Okay, this amount you had spent for 12 months, because 1/4/2016 you had spent this amount, and this is completed on 31/3/2017. For this entire 12 months period, we will be incurring borrowing cost on this 10 lakh rupees. When it comes to this 24 lakhs that is taken on 1/8/2016, you would have incurred borrowing cost on 8 months only, because 1/8/2016 to 31/3/2017, that much only we can capitalize. Then when it comes to the amount you had spent on 1/1/2017, you can have only 4 months interest. Okay, sorry, 4 months, not 4 months, it is 3 months. Okay, you can have only 3 months interest, because from that date only you had utilized this amount. Therefore, what you have to consider is that when it comes to spending of amount in installments, from the date of expenditure, you should give preference to the time. Okay, from the date of incurring expenditure to the date of cessation of capitalization, till that period only will be incurring borrowing cost. So that much interest only we need to consider. So we have to time weight our expenditure. That will be our first working note. Okay, our first working note will be time weighted expenditure. So working note number 1, that is expenditure incurred. Okay, expenditure incurred. We are going to consider the time weighting factor. So date, amount, number of months, then weighted amount. Okay, this is the expenditure you had incurred. So on 1/4/2016, you had spent 10 lakh rupees. This was there for 12 months period. Okay, the total weighted amount is 10 lakhs itself, because 10 lakhs into 12/12. Okay, this is the total weighted amount. The next one, if you consider you had incurred an expenditure on 1/8/2016, that is 24 lakhs. Okay, there is 8 months you had used this amount. That means 16 lakhs. 16 lakhs. How 16 lakhs? 24 lakhs into 8/12. Okay, here it is 10 lakhs into 12/12. Then when it comes to next expenditure on 1/1/2017, they had incurred 4 lakh rupees. Okay, this was there for 3 months only. That means 1 lakh rupees will be your weighted amount. That is nothing but 4 lakhs into 3/12. Okay, so total weighted expenditure will be 10 lakh plus 16 lakh plus 1 lakh. That is 27 lakhs is your total weighted amount. Okay, total weighted amount is 27 lakh. You had totally spent 38 lakhs, right? You had totally spent 38 lakhs, but after considering time weighting factor, your weighted expenditure is only 27 lakhs, out of which 8 lakhs is this 27 lakhs you are having as borrowing cost because you have weighted expenditure, out of which 8 lakhs is your specific borrowing. Okay, 8 lakh is your specific borrowing. Out of the specific borrowing, what you can capitalize? Actual borrowing cost, that is 8 lakhs into 8 lakhs into what is the interest rate applicable for specific borrowing? That is 10%. 10%. You can capitalize 80,000 for this. So what will be the utilization from general borrowing? The utilization from general borrowing will be 27 lakh minus 8 lakhs. That is nothing but 19 lakhs. That is nothing but 19 lakhs into what is your weighted average rate? Your weighted average rate is 12%. Your weighted average rate is 12% on general borrowing. So 19 lakhs into 12%, you will get rupees 2,28,000. Rupees 2,28,000. This is the amount which we can capitalize. So this is your working note number 2. Borrowing cost can be capitalized. Borrowing cost eligible for capitalization. Borrowing cost eligible for capitalization. From specific borrowing, you can capitalize 80,000 as borrowing cost. That is nothing but your actual borrowing cost. Okay. Temporary income from temporary investment is nil. That is why we had not considered this aspect. Then apart from this, how much expenditure we had incurred? That is general borrowing. So general borrowing, what is the utilization into what is the rate you had arrived at? What is the amount of interest cost we can capitalize? So നമ്മുടെ main answer, we are going to the main answer. What is the main answer? We have to compute what is the cost of asset. Okay, main answer, cost of asset. Total cost incurred is rupees 38 lakhs. Rupees 38 lakhs. Add borrowing cost. How much we can capitalize? Specific borrowing, we can capitalize 80,000. General borrowing, we can capitalize 2,28,000. Total 3,08,000 we can capitalize. Therefore, cost of asset as per AS10 and AS16. Okay, cost of asset as per AS10 and by applying the provisions of AS16 is that 38 lakhs plus 3,08,000, that is nothing but 41 lakhs rupees, 41 lakh 8,000 rupees, 41 lakh 8,000. So this is your case when it comes to this question. Are you clear with this? Are you clear with this? Are you clear with this? Okay. So what we will do is that we'll be having some more questions from RTP. So if you check this question, a company incorporated in June 2017 has set up a factory with a period of 8 months with borrowed fund. The construction period of asset has drastically reduced due to usage of technical innovation by the company. Whether interest on borrowing for a period prior to the date of setting up a factory should be capitalized, although it has taken less than 12 months for assets to get ready for its asset. You are required to comment on the necessary treatment with reference to AS16. So this is a simple question. They are asking about the definition of qualifying asset and the guidance when it comes to substantial period of time. What is said in the standard is that qualifying asset is an asset which takes substantial period of time to get ready for its intended use or sale. The borrowing cost you had directly incurred in relation to acquisition, construction, or production of this type of qualifying asset can only be capitalized. The standard had not defined the substantial period of time in this standard. Okay, the institute had not defined that. So the guidance which is contained in the standard is that substantial period of time needs to be identified based on the facts and circumstances of each case. Usually a period of 12 months is considered as substantial unless a longer or shorter period can be justified. In the given question, they had used more technology, and that is the reason why the period of construction is reduced to 8 months. So this 8 months can also be considered as substantial based on the facts and circumstance. So less than 12 months, standard also permits to capitalize borrowing cost for an asset which took only less than 12 months for its construction. Also, there is no bar. You have to consider the facts and circumstances of each case. Okay. Next, we will see another RTP question. In May 2016, Capacity Limited took a bank loan to be used specifically for construction of new factory building. Construction was completed in January 2017. This is the same question we had done as your question number 1. Okay, same question they had given us your revision test paper question. So these are the type of question you can expect from. These are the certain type of question you can expect from your borrowing cost standard. So this is your first group accounting standard AS1, 2, 10, 11, 12, and 16. These standards alone constitute around 20 marks. Cash flow, investment accounting, both these areas are asking separately. Apart from this, these six standards alone constitute around 20 marks when it comes to your examination. So this is an important area from your examination point of view as well. So are you clear with the first group accounting standards? Are you clear with the first group accounting standards? Okay. So can we move to the second group? That is, there are more number of standards in that in that. So I'll not be discussing this much in depth when it comes to those set of standards, because when it comes to the standards, they had reduced the number of standards so they can increase the toughness of question here, because in-depth knowledge is required, but the thing is that there are only limited number of standards, so the questions can be in-depth model also henceforth. Okay, this is the first attempt after they had switching two standards from this. Okay, earlier this AS 17 on segment reporting and AS 22 on accounting for taxes on income, all these were part of your first group. Now this has shifted to your second group with effect from this May 2020 examination. Effectively now it is July 2020 examination. So this is the first attempt. The upcoming attempt is the first attempt in which they are going to ask questions based on the six standards alone. So the level of depthness will be in-depth questions when it comes to this from this attempt onwards, because these are core standards. Okay, these are certain core standards which is applicable to most of the entities. Okay, so we'll go to the second group standards. Second group. Okay, if you consider this, we are having around 12 standards in this group. We are having AS4, AS5, AS7, AS9, then AS17, 18, 19, 20, 22, 24, 26, 29. This much standards are there in your second group. So we are going to see each standard, but the time we had taken for each standard in first group, that much time may not be taken in second group. Why? Because the number of standards is more. So we'll be discussing only the relevant points. Okay, so first we will start with AS4 on contingencies and events occurring after balance sheet date. Okay, before moving on to the standard, we have to understand certain basic accounting principles. We are preparing financial statements. We are following a going concern concept, right? That is, the entity will continue for its foreseeable future. Okay, entity will continue for a foreseeable future, but the trader or the entity needs to identify what is their results of operation on a periodical basis. That is the reason why we are preparing financial statements. While we are preparing financial statements, we'll be following a concept known as periodicity concept. Okay, periodicity concept. Okay, what this concept states that we will divide the entire life of this enterprise into different periods. We'll analyze what are the transactions in one period that will be reflected in one financial statements. So we will divide this entire life of entity into different periods, and for this period we are preparing this financial statements. And if you check accrual base of accounting and matching concept, if you are seeing these two items, accrual concept states that transactions and events needs to be recorded to the period to which it relates. Matching concept states that revenue earned should match with expenditure incurred in that period. Okay, likewise when it comes to financial statements, what we are seeing is that we are preparing financial statements for 2019-20. Okay, we are preparing financial statements for 19-20. Whatever be the events that had happened, whatever be the transactions that is happened in this period, will be reflected in the financial statements for 1920. Okay, this is our basic principle. This standard is an exception for this. Okay, this standard is an exception for that. That is, in certain cases, some events may happen after this balance sheet date. Okay, some events may happen after this balance sheet date that may indicate a condition as at this date. This will provide further evidence of certain condition as at this date only if we adjust the impact of those items. Our financial statements will reflect a true and fair view. Our financial statements will reflect a true and fair view. Therefore, we have to adjust certain event which had happened after this balance sheet date also. Okay, how we should do that? For which all items we have to do this adjustment? That is what which is given in the standard. So, are you clear with the background in this which this standard is issued? Just there will be certain events which will provide further evidence of a condition existed at balance sheet date. Okay, certain events after balance sheet date will also provide further evidence of a condition existed at balance sheet date unless we adjust those events, unless we adjust those items in our financial statements will not reflect true and fair view. In order to make it possible, standard gives an exception to periodicity concept. That is the standard. Okay, are you clear? Are you clear this? Are you clear with this? Okay, so we'll see what is an event occurring after balance sheet date. If you check the standard, its name is contingencies and events occurring after balance sheet date. Initially, when the standard was introduced, the standard was dealing with how we should treat contingent loss, contingent profit, contingent assets, and all. But consequent to the introduction of AS 29, the scope of this standard is limited to events occurring after balance sheet date only, because this contingency part is being governed by AS 29 provisions, contingent assets and contingent liabilities and contingent assets. So consequent to the introduction of AS 29, AS 4's scope is limited to events occurring after balance sheet date only. That is why we are only discussing about events occurring after balance sheet date. Contingency part, okay, to that extent, it is not applicable. There is in standard we can see the guidance, but this is not applicable for us consequent to the introduction of AS 29. Okay, so this is the case. So first we will see what is the definition of events occurring after balance sheet date. Events occurring after balance sheet date. First of all, this will be those significant events. That means only material items will be considered. Only material items will be considered here. Clear? This will be both significant events, both favorable and unfavorable. Will only consider, will not use the prudence concept, will only consider unfavorable. That is not the case here. We will consider both favorable and unfavorable events. Okay, these are those significant events, both favorable and unfavorable. Okay, that occur between the balance sheet date. Okay, that occur between the balance sheet date and the date on which financial statements are approved by board of directors in case of company, by corresponding approving authority in case of any other entity. Okay, this event occurring after balance sheet date are those significant events, both favorable and unfavorable, that occur between balance sheet date and the date on which financial statements are approved. So if your financial statements date is 31/3/2020 and you are having various dates, for example, on 30th/4/2020, financial statements prepared by management. Financial statements prepared by management. On 30th/5/2020, financial statements approved by board of directors. Okay. On 30th/6/2020, audit completed. Okay. Then on 31/8, shareholders approved. Okay. Shareholders approved the financial statements. Okay. These are certain events we can see in routine course. So first of all, management will prepare the financial statements. Then it will be approved by the board of directors. Then it will be handed over for audit. Audit report will be issued. Practically, audit will commence from this date. This verification part the auditor will complete. Whenever the financial statements approved by board, within 1 or 2 days, audit will also complete because all items will be considered by auditor in advance. They only need to consider the final financial statements. Draft financials they would have verified. So audit will complete by 30th/6 and shareholders approval is received on 31/8. When it comes to the standard, the scope is still here. That is, from the balance sheet date to the date of approval of financial statements by board of directors. Okay, from the date of balance sheet to the date of approval of financial statements by board of directors or corresponding approving authority. Is it clear? Is it clear? Is it clear? What is the definition of events occurring after balance sheet date? Is it clear? From balance sheet date till the approval of financial statements. Okay, approval by board only is necessary. Okay, the next aspect we are going to consider the type of events. So events occurring after balance sheet date, we will divide it into two. First one, adjusting event, and second one is non-adjusting event. The first one is adjusting event, second one is non-adjusting event. What is the case when it comes to adjusting event? This condition, okay, there was a condition existed at balance sheet date. What the event conveys is that it is only a further evidence of this condition existed at balance sheet date. For example, there is a theft by cashier on 30th/3/2020. Okay, there is a theft by cashier on 30th/3/2020. This was identified only on 5/4/2020. Okay, that means cashier had absconded with 10,000 rupees. This is the case. Okay, we'll check this case. If your cash balance as per books as on 31/3/2020 is 25,000, this 10,000 this cashier had taken. Okay, if this is the case, actually physical cash balance would only be 15,000, right? Physical cash balance would only be 15,000. This is your condition existed at balance sheet date, but your book shows 25,000. Why? Because we had not we did not know about this theft, right? This we had identified on 5/4/2020. In order to reflect the actual balance, we will account for this theft. So this theft is an item existed. Okay, this item is existed at balance sheet date, but only discovered later. But only discovered later. That is, it provides further evidence of a condition existed at balance sheet date. Is it clear? What is adjusting event? Is it clear? For example, we are having a debtor. He was having severe financial crisis, and we had created provision for his debt as on 31/3/2020. After balance sheet date, he became bankrupt. That is, the amount, the collectability of amount, there was some uncertainty that was known to us earlier also. The subsequent events declaring him as insolvent is a further evidence of a condition existed at balance sheet date, that is, the amount is not recoverable, that is finalized. Likewise, we should consider whether this is an event occurred after balance sheet date or it provides further evidence of a condition existed at balance sheet date. If it provides further evidence of a condition existed at balance sheet date, those type of events are known as adjusting events. Those type of events are known as adjusting events. If these items arose just subsequent to balance sheet date, those type of items are known as non-adjusting events. Okay, if there is a condition existed at balance sheet date, this event only provides further evidence of that condition, then it is an adjusting event. Then the impact will be accounted. We'll adjust assets and liabilities in the books if it is materially affects the information in the balance sheet date. Okay, then when it comes to non-adjusting event, we will not adjust those items. We will only provide disclosure if it is a material item by considering its special nature, legal requirements, etc. Okay, otherwise disclosure will only be made in the reporting approving authorities report, that is board of directors report. Okay, so this is the case when it comes to your adjusting event and non-adjusting event. Are you clear with this concept? Adjusting event and non-adjusting event. Adjusting event, non-adjusting event. Are you clear? Okay, when it comes to adjusting event, we will adjust that in the financial statements. That is, assets and liabilities will have implication. We will disclose its impact in the financial statements if required. When it comes to non-adjusting event, we will not adjust that in the financial statements. Usually it is disclosed in the report of approving authority. But if it is a material item that will have a higher bearing on financial statements, considering its special nature, considering the legal requirements, we may disclose it in the financial statements also. Usually it is disclosed in the reporting authorities report. Then there are events which take place after balance sheet date. There are certain events which takes after balance sheet date. Okay, but this needs to be reflected in the financial statements due to statutory requirements or their special nature. So there are certain non-adjusting events for which disclosure is required. Okay, for which disclosure is required in this financial statements by considering statutory requirements or because of their special nature. Example of such item is that proposed dividend. Okay, dividend declared after balance sheet date But before financial statements are approved for issue, this we will not consider it as a adjusting event. This is a non-adjusting event, but what we will do is that we will disclose this in notes due to statutory requirements. We will disclose this in the notes due to statutory requirements. So if there is any proposed dividend that will not be taken, that will not be adjusted in the balance sheet date, that will only be disclosed due to statutory requirements, because we do not have any liability asset balance sheet date. Clear? Next, there is an exception to this general rule also. There is an exception to general rule also that takes place when it comes to going concern. Okay, that comes into picture when it comes to going concern assumption is affected. That is, if there is an event which has a bearing on going concern concept, okay, on subsequent to balance sheet date, an event which states that going concern assumption is not valid, which indicates that going concern assumption is not valid, then we will consider it as adjusting. Okay, this is the only exception. After balance sheet date, we come to know that there is a condition which causes issues to going concern aspect. For example, 31/3/2020, you were running your business. 31/3 is your balance sheet date. This plastic ban we are that introduced by our government, that had introduced on 30/4/2020. We'll assume this. We'll assume likewise there is a plastic manufacturing company. Their financial statements for 31/3/2020 is being prepared. On 30/4/2020, plastic ban comes. Okay, there is plastic ban. This is not a condition existed at balance sheet date, but due to this plastic ban, this is a condition arose subsequent to balance sheet date. But due to this plastic ban, going concern is not valid. Going concern assumption is not valid because you are a plastic manufacturing company. You cannot produce your product henceforth. Okay, if this is the situation, we cannot use the going concern assumption, because going concern assumption is not valid. We will treat it as an adjusting event. We will not prepare this financial statements on a going concern basis. We will account for assets based on its realizable value, liabilities at its settlement value, and we cannot follow historical course convention if going concern assumption is affected. So only in case of going concern assumption, we will adjust a subsequent event. Okay, that is, a non-adjusting event will be adjusted only in case of going concern assumption is not valid. Are you clear with this aspect? Are you clear with these aspects? Clear for everyone? Is it clear? Okay, so what we will do is that we'll do some problems on this so that you'll be comfortable. So the first one, we'll take this question number 5. A Limited closes its books on 30/6/2017. Their balance sheet date is 30/6/2017. The accounts for the period was considered and approved by Board of Directors on 20th August 2017. The company was engaged in laying pipeline for an oil company deep beneath the earth. Okay, while doing the boring work on 1/9/2017, they had met with a rocky surface. It was estimated that there would be an extra cost to the tune of 80 lakhs. You are required to state with reason how the event be dealt with in the financial statements for the year ended 30th 6 2017. Okay, so they are closing their financial statements on 30th 6 2017. They had approved their financial statements on 20th August. On 1/9 2017, they met with a rocky surface and they estimated that your total cost of this project would increase 80 lakhs, so that you can only recognize lesser profit. You can only recognize lesser profit. So how this event will be considered in the financials? So we are having three options. A, it will be adjusted in the financial statements as it is an adjusting event. Second one, it will be a non-adjusting, not adjusted, as it is a non-adjusting event. Third one, it is not adjusted, not considered. It will not be considered at all. Will not be considered at all. Will not be considered at all. Which is the correct answer for this? Which is the correct answer for this? You are having three options. Why? Okay. So you should be careful with the definition of events occurring after balance sheet date. Events occurring after balance sheet date are those significant events, both favorable and unfavorable, okay, that occur between balance sheet date and the date on which financial statements were approved by board of directors. So only event occurred between these date will constitute event occurring after balance sheet date. Okay, events occurred after balance sheet date. What happened in this case is that this event had happened on 1/9/2017. Therefore, this will not be considered in the financial statements at all. Why? Because this financial statement is approved on this date. Preparation of financial statement is complete by this date. Only after that this had came to our knowledge. Only after this it had came to our knowledge. So what we will do is that we will not adjust this. Okay, but if it was before this, we would have considered this extra cost as part of your cost of project. Based on that, you would have revised your percentage of completion. Why? Because this rocky surface was there in before also. That came to know only upon the stage. That's the case. So this is a condition existed at balance sheet date, but they provide a further evidence of a condition existed at balance sheet date. That's it. Okay. So if it was within this, it would have been an adjusting event. So are you clear with this? Are you clear with this question? Okay. So we'll take the question number 1. There is a theft of cash 5 lakhs by cashier in January 2017, detected in May 2017. Financial statement noted approved. Theft of cash, whether it is to be adjusted. A, whether it is an adjusting event. B, whether it is a non-adjusting event. What is your views on this? Whether it is an adjusting event or non-adjusting event? I had taken the same example. Okay, theft. This is an adjusting event because the condition existed at balance sheet date. further evidence of a condition existed at balance sheet date alone. Okay. Next one, an earthquake destroyed major warehouse of Akko Limited on 20th 5 2017. Accounting year entered on 31 3 2017. Financial statements approved on 30th 6 2017. Loss from earthquake is estimated at 30 lakhs. State with reason whether the loss due to earthquake is an adjusting event or non-adjusting event, and how the fact to be disclosed by the company. So first, whether it is an adjusting event, B, whether it is a non-adjusting event, or it is not an event occurring after balance sheet date. What is the case in this case? In this situation, what is the whether it is an adjusting event or non-adjusting event? Okay. So in this case, it is a non-adjusting event. This event had occurred only on 20th 5 2016. If you check, first you have to consider whether it is an event occurring after balance sheet date. That is whether it is between 31 3 17 and 30th 6 2017. Yes, 20th 5 is in between. So this is an event occurring after balance sheet date. Okay, so third option is getting eliminated. Next one, this happened on this date. This is not a condition existed on 31 3 2017. This happened on 20th 5 only. That means it will be a non-adjusting event. It is a condition arose subsequent to balance sheet date. Right? It is a condition arose subsequent to balance sheet date. So it will be a non-adjusting event. This will be disclosed in the report of approving authority. Report of approving authority. Or if it is so material, okay, by considering special nature, we may disclose in the financial statement. Okay, disclose in financial statements. If it is a major loss due to which going concern is affected, going concern is no longer valid, it will become an adjusting item also. Okay, clear? So you should consider all possibilities. So if it is a 5 marks question, you should write all these probabilities. Clear? If it is earthquake, you should think from your mind, that is earthquake, there can be a possibility for a huge loss also. For example, this is not insured, this amount is not insured, and they are having us, this is a small company, their investment is also a lesser amount, 40 lakhs 45 lakhs is their investment amount. They had incurred a loss of 30 lakhs due to earthquake. Whether they can survive in future, and there is no life insurance with respect to this, then they cannot survive. Then if this is the case, going concern assumption may not become valid, then those items needs to be adjusted also. That needs to be adjusted in the financial statements also. Clear? Usually it is a non-adjusting event. Disclosure will be required in approving authorities report. By considering special nature, by considering materiality, we can include in the financial statements as a disclosure. If going concern assumption is not valid, we have to adjust the assets and liability values, since fundamental accounting assumption is not valid. We have to go for separate basis of accounting. Clear? Okay. Next we will others on. Is it okay for you? Others? I had only received 8 replies. Okay. So the next we are going to see another question. A company had filed a lawsuit against a debtor from 15 lakhs is recoverable as on 31/3/2017. Okay. Chances of recovery by way of legal suit are not good as per legal opinion given by counsel in April 2017. Can the company provide for full amount of 15 lakhs as provision for doubtful debts? Whether they can do it? This amount is receivable from long back. We had given a case against them. The advocate says that possibility of winning this case is remote. That means this is a condition. This is a further evidence of a condition existed at balance sheet date itself. You can very well provide for your provision for provision for bad and doubtful debts. Okay, you can very well create provision in this case. Next one. In preparing financial statements of R Limited for the financial year ended March 31, 2017, you come across the following information. State with reason how you would deal with this in the financial statements. Company invested in 100 lakhs in April 2017 before approval of financial statements by board of directors in acquisition of another company doing similar business, the negotiations for which had started during the year. A, whether it is an adjusting event. B, whether it is a non-adjusting event. C, it is not an event occurring after balance sheet date. What is the case here? This you have to consider this. Company invested 200 lakhs in April 2017. Okay, there is another company doing similar business. Negotiation started during 2016-17 itself. Whether it is an adjusting event, non-adjusting event, or not at all an event occurring after balance sheet date. What is the case? What is the case? Others, please respond. In this case, the correct answer is it is a non-adjusting event. It is a non-adjusting event. Okay, adjusting event are those items which provide further evidence of a condition existed at balance sheet date. Merely because of negotiation started during the year, we cannot say that this is a condition existed at balance sheet date. We cannot say that this is a condition existed at balance sheet date. Only negotiation started. After this negotiation, this may result in a positive way. This may result in a negative way. This had resulted in a positive way only in April 2017. On this date only, it is a condition. This condition exists. This is a condition arose subsequent to balance sheet date. They had invested this amount. This is only after this balance sheet date. So merely because of this negotiation started during the year, we cannot consider it as an adjusting event. We can consider it as a non-adjusting event only. Okay. When it comes to non-adjusting events, by considering its significance, by considering its materiality, we may provide disclosure in the financial statements, but we cannot adjust those items. So this is not an adjusting event. This will be a non-adjusting event itself. Clear? Are you clear with this? Clear with this? Okay. So next one. While preparing the financial statements for 31st March 2017, a company made a bad debts provision for 5%. In last week of February 2017, a trade receivable of 2 lakhs had suffered heavy loss due to earthquake. Loss was not covered by insurance policy. In April 2017, trade receivable become bankrupt. Can company provide for full loss arising out of insolvency of trade receivable in the final accounts for the year ended 31st March 2017? Whether it is adjusting, non-adjusting, or not even and even occurring after balance sheet date, what is the situation here? Whether it is an adjusting event or non-adjusting event. This is very well an adjusting event because this earthquake loss they had suffered, all this happened in February 2017. The bankruptcy is just an further evidence of a condition existed at balance sheet date. His financial position was weak. It is confirmed by a subsequent event. That's it. So we can provide for entire loss. So these are the type of question you can expect from this. So are you clear with the standard? Are you clear with the standard? ES4 contingencies and events occurring after balance sheet date. Clear? Okay, so we'll take a quick 5 minutes break. Then we will restart by 12:25. Okay, we'll restart by 12:25 and we will continue with a new standard, that is AS5. AS5, net profit or loss for the period, prior period items and changes in accounting policy. So it has 2-3 parts. So we'll cover 1 or 2 parts today. Okay, we'll not be covering the entire standard. We'll cover 1 or 2 parts today. Okay. This is your next standard. Next standard, that is nothing but ES5, net profit or loss for the period, prior period items, and changes in accounting policies. So the standard deals with various aspects. So we will divide the standard into 4 parts. First one is net profit or loss for the period. The first part is net profit or loss for the period. Okay. In this, we will learn what is ordinary activities. Okay. What is extraordinary activities? Okay. What is extraordinary items? And what is your exceptional item? Okay. What is exceptional item? So these 3 concepts we will learn in your net profit or loss for the period. Then you will learn what is prior period item. Then you will learn what is the treatment when it comes to change in accounting estimate. And then you will also learn what is the treatment when it comes to change in accounting policies. So these are the 4 parts we are going to deal when it comes to the standard. Okay, so you'll be having net profit or loss for the period. In that you will see what is ordinary activities, what is extraordinary item, and in ordinary activities itself, what constitute exceptional item. Okay, these 3 concepts we will learn. Then we will move to prior period item. Then we will move to change in accounting estimates and change in accounting policies. So there is a narrow gap between these 2. So we have to clearly identify these 2 items. Okay, so first one is net profit or loss for the period. Net profit or loss for the period, that is As per the standard, all items of income and expense which are recognized in a period should be included in the determination of net profit or loss unless another accounting standard requires or permits otherwise. What is the meaning of this? Usually all income and expense should be taken to P&L unless otherwise specified. For example, we had seen borrowing costs just before. So if you had incurred any borrowing costs in relation to acquisition, construction, or production of qualifying asset, you can capitalize. There is an interest expense, but you can capitalize. That is permitted, that is required as per AS 16. So you will be capitalizing that only. Balance you have to take it to P&L. That is the guidance. Or you had seen para 46 or para 46A exemption when it comes to AS 11. That is foreign currency in case of long-term foreign currency borrowings, and that is for a depreciable asset. You can take it to the cost. There is an option given. There is an item permitted as per AS. So that need not be taken to expenditure. That need not be taken to P&L. Otherwise, if nothing is mentioned, all item of income, all item of expense, that needs to be taken to P&L, and that is to be included in the determination of net profit or loss for the period. You cannot directly adjust to reserves any item as per your convenience. Okay, you cannot adjust certain items, you cannot take certain items to your reserves based on your convenience. You can only take if it is given as per your accounting standards. If this expenditure can be taken to capital reserve, then capital reserve can be taken. Otherwise, you cannot take any income or expense to other than P&L. You have to take it to P&L. That is the first guidance given in this standard. Second one, while determining the net profit or loss for the period, okay, for 1 year, we are determining the net profit or loss for the period. Following two components should be disclosed separately. These two components should be disclosed separately. That is, profit or loss from ordinary activities. Second one, extraordinary items. Okay, profit or loss from ordinary activities and extraordinary item, you should disclose separately. That is why if you check your schedule 3 statement of P&L format, you are having profit or loss before exceptional items and extraordinary items. Okay, then you are reducing exceptional items. Okay, then you arrive at profit or loss before extraordinary items. Then you are reducing extraordinary item. Likewise, they had given a presentation in accordance with this guideline, that is net profit or loss from ordinary activities, that needs to be specifically segregated from extraordinary items. Each component should be disclosed on the face of statement of P&L. That is why they had given such a disclosure. Be clear? Okay, schedule 3 is designed in such a way, it is based on accounting standard 5. Schedule 3 P&L format is largely dependent on AS5 we are learning, as well as AS24 we'll learn sometimes later. So though these two standards had influenced your schedule 3 P&L format, we will see these two elements. Okay, so this is the case. So are you clear with this? You have to separately state profit or loss from ordinary activities as well as extraordinary items. So we have to understand what is the meaning of profit or loss from ordinary activities and extraordinary item. So we are going to discuss that. Ordinary activities means that are undertaken by the enterprise as part of its business. Ordinary activities are activities which are undertaken as part of its business and such related activities. Okay, and such related activities engaged in furtherance incidents or arising from this activity. So mainly ordinary activities means these are related to our business. Okay, these are related to our business. These will recur frequently. This will recur frequently. This will be a regular item, or it will be a frequent item when it comes to your financial statements is concerned. That is your ordinary activities. It is your ordinary activities. Second type is your extraordinary items. Extraordinary item means it may be an income, it may be an expense. It may be an income, it may be an expense that arise from events or transaction that are clearly distinct, from ordinary activities. Okay, what is not related to our normal course of business, what is not related to our normal activities, that is known as extraordinary item. These are not expected to recur frequently or regularly. That is not expected to recur frequently or regularly. This is first aspect. It is clearly distinct from operating activities. Second one, not expected to recur frequently or regularly. If these two criteria are satisfied, those type of items are extraordinary item. Those type of items will be extraordinary items. So whether an event or transaction is clearly distinct from ordinary activities is determined by the nature of the event or transaction in relation to the business ordinarily carried out, rather than by frequency with such event are expected to occur. Okay, whether it is in the ordinary course of business or not, this is based on facts and circumstances of each case, based on each enterprise. For example, we are having a loss from earthquake, loss due to earthquake. Okay, this will be an extraordinary item as far as a normal entity is concerned. But when it comes to an insurance company, the claim submitted for loss from extraordinary item will be in their ordinary course, because their business is providing insurance. Claim processing is their ordinary course of business. So are you clear with this? Based on the nature of enterprise, we have to consider whether it is an extraordinary item or ordinary item. Clear? Are you clear? Are you clear with this ordinary item and extraordinary item? Net profit or loss from ordinary activities and extraordinary item. Clear? Clear? Next we will see another item, exceptional item. Okay, it is not extraordinary, exceptional item. That means exceptional items are income and expense. It may be items of income and expense within profit or loss from ordinary activities. That is, these are certain items within ordinary activities itself. Okay, within ordinary course of business itself, but it is of such size, nature, or incidence that their disclosure is relevant to explain the performance of the enterprise. That is, these are ordinary activities alone, but its disclosure is necessary for understanding the financial disclosure by considering its materiality, its size, or its nature, or its impact in financial statements, or considering all these items. If it is to be disclosed separately for the purpose of understanding this entity's performance, okay, these are not occurring frequently. This is, or rarely occurs, but is within the ordinary course itself. So in order to understand the usual profit, usual financial performance, a separate disclosure may be required. These type of items are known as exceptional items. These are not occurring frequently, but it is within the within the ordinary activities itself, or its disclosure is necessary to understand financial performance. It is of such material items. So if this is the case, these type of items are known as exceptional item. Okay, so exceptional item, those should be disclosed separately. This name exceptional item is not given by the standard. This name is given by your schedule 3. Okay, standard only states this: when item of income and expense within profit from ordinary activities are of such size, nature, or incidence that their disclosure is relevant to explain performance of the enterprise for the period, nature and amount of such items should be disclosed separately. This is the guideline in standard. Based on that, your schedule 3 named it as exceptional item. Based on this, schedule 3 named it as exceptional item. Please remember this. Okay, exceptional item that is not mentioned in the standard. If you check AS5, you cannot see the name exceptional item, but the schedule 3 named it as exceptional item. Okay, so what are the examples given in the standard? Write down of inventories to NRV. Okay, usually NRV will be carried at cost or cost and net realizable value, lower of cost and net realizable value. Usually this cost will be lower value. NRV will be lower in exceptional situations. So those will be treated as, those will be disclosed separately. Okay. Next one, restructuring activities of the enterprise and its related provisioning. So this is not occur frequently, but it is related to ordinary activities. So this will be required to be disclosed separately because if it is included in your normal profit or loss, financial position, financial performance may not give a proper picture. So that is your case. Next one, disposal of items of fixed assets, disposal of long-term investments, legislative changes having retrospective application, litigation settlements, then reversal of provision we had created earlier that is no longer required. All these will be considered as exceptional items. So are you clear with this exceptional item also? Are you clear with this exceptional item also? Okay, so this is your net profit or loss for the period later guidance. Okay, this is your net profit or loss for the period later guidance. Next, we will check this prior period item also because there is a small guidelines related to prior period item. So prior period item, we will understand what is the meaning. Okay, prior period items are income or expense. Okay, these are income or expense which arise in current period. It is recorded in current period. Okay, which arise in current period means it is recorded in the current period. Okay? As a result of error or omission, as a result of error or omission in the preparation of financial statements in one or more prior periods. So this may be an income, this may be an expense. This arise in current period. What is the crux to identify prior period item? Whether there is any error or omission in the preparation of financial statements in prior periods. At the time of preparing those financials, they would have considered this. They could have considered this, but they have not considered, or they had considered it erroneously. If this is the case, this will be a prior period item. All income expense related to previous years are not prior period items. Only if there is an error or omission in the prior periods, it will meet the definition of prior period. For example, there is a there is a loss due to fire in 2014. Okay, the claim was approved. This claim was approved in 2016. You are accounting this in 2016-17 financial year. Even though the claim is relating to 2014-15, this cannot be treated as a prior period item because while preparing your 14-15 financials or 15-16 financials, you have not committed any error or omission. Okay, only because it was not approved, you are not accounting that. So items relating to previous years are not your prior period items. Your prior period item means it is an income or expense arise in current period as a result of error or omission, as a result of error or omission in the preparation of financial statements in one or more prior periods. Okay, this is an important aspect because most of the students confuse about this prior period items and what the items relating to previous years. Items relating to previous years will not always be a prior period items. In order to treat something as prior period item, crux is that there should be an error or omission. There should be an error or omission in prior periods. Clear? If that is the case, these items, nature and amount of these items should be disclosed separately in a manner its impact on current profit or loss can be perceived. That means it needs to be disclosed separately in statement of P&L. Clear? Are you clear with ordinary activities, extraordinary item, exceptional item, prior period item? Are you clear with these four items, four aspects? Are you clear with these four aspects? Okay, so we'll do some problems on this. So, first one, fuel surcharge is billed by State Electricity Board at provisional rates. Okay. Final bill for fuel surcharge of 5,30,000 for the period from October 2008 to September 2015 has been received and paid in February 2016, but it is accounted in the year 2016-17. Comment on the accounting treatment. Okay, what happens is that do you know how this billing of KSEB is done now due to Corona outbreak? Usually, what they do is that a person from KSEB comes to our place and they'll check the meter reading. Based on that, they will issue the current bill, right? Electricity bill. But in this COVID-19 period, what they had done is that they had taken 3 months average usage, your bill, and based on that, they had raised a bill to you. And this will be after this COVID-19 issues get over, they will collect any excess amount in case of excess usage. They will adjust the amount collected in excess when it comes to a reduced amount. Okay, this is the case when it comes to your what KSEB done for billing. Okay, this type of billing is known as provisioning billing. This is not final amount. Final amount will be settled. Final amount will be arrived at later. At the time of arriving at final amount, some amount needs to be paid by us or some amount needs to be refunded to us. Okay, here one state electricity board was charging fuel surcharge on provisional rates. The additional charge on fuel that was at provisional rates. This from October 2018 to September 2015. October 2008 to September 2015, they were providing provisional bill. Okay. For this entire period, they had calculated the final amount. Based on that, we have to additionally pay 5.3 lakhs. Okay, based on that, we have to pay additional 5.3 lakhs. We had paid that in February 2016. It is accounted in 16-17 financial year. How it needs to be treated? This is the question. So first, whether it is an ordinary item, whether it is an exceptional item, whether it is an extraordinary item, whether it is a prior period item. Okay? Whether it is a prior period item. So this is our question. So what is your answer? What is your answer on this? How this will become a prior period item? How this will become a prior period item? Because if you check this, here, what happens is that your fuel surcharge, it was billed in February 2016. This is in the financial year 2015-16. You had paid this amount in February 2018, but it is accounted in the financial year 2016-17 only. So you are staying here. You are at the 31/3/2017. If you consider 31/3/2017, this is an income or expense arise in current period, that is recorded in current period due to an error or omission in the preparation of financial statement for 15-16. Okay, this item would have accounted in the financial year 2015-16, but they had not recorded this. Therefore, you are recording in this period. Since there is an error in the year 2015-16, this will be treated as prior period item. Okay, this will be treated as prior period item. Are you clear with this? This is not treated as prior period item merely because it relates to 2008 to 2015. Why we had taken it as a prior period item? Only because there is an error or omission in 15-16 financial statements preparation. They had omitted to record this transaction in February 2016. That is the reason why we are treating it as a prior period item. Clear? Clear with this? Are you clear with this? Okay, so we'll take next one. During the year, a medium-sized company wrote down its inventory to net realizable value by 5 lakhs. Is a separate disclosure necessary? 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 Yes. Why? Because just analyze the situation. It is a medium-sized company. It is a medium-sized company. That means their turnover is not much. Their operations is not much. It is not a bigger company. It is a medium-sized company. For them, this 5 lakh rupees may be material for them. So what we need to is that it is an item within ordinary activity. It is an item within ordinary activity which is of such size, nature or incidence, which is of such size, nature or incidence that their disclosure is relevant to understand the financial performance. Their disclosure is relevant to understand their financial performance. Therefore, it needs to be separately disclosed. Therefore, it needs to be separately disclosed. These type of items will be disclosed as exceptional items. Okay, these type of items are disclosed as exceptional items. Are you clear with this? Clear with this? Okay. Next one we'll take this question also. The company signed an agreement with employee union on 1/9/2016 for revision of wages retrospectively from 30th/9/2015. The company would cost additional liability of 5 lakhs per annum. Is a disclosure necessary for the amount paid in 2016-17? A, whether it is an ordinary item. B, whether it is an extraordinary item. C, whether it is an exceptional item. D, whether it is a prior period item. Okay, you had entered into an agreement with employees union on 1/9/2016 to revise this wages from 30th/9/2015. Okay, due to this there is an additional liability of 5 lakhs because from 30th/9 to 2000 to 30th/8/2015. Okay, so there is a period. This period they had paid lesser wages. For this you have to additionally pay 5 lakh rupees. How this item needs to be recognized, whether it is a ordinary item, whether it is an exceptional item, whether it is an extraordinary item, or whether it is a prior period item. How it needs to be treated? How this needs to be treated? Okay, so just analyze the situation. We are in the financial year 1/4/2016 to 31/3/2017. Okay, on this date, on 1/9/2016, they had entered into an agreement to revise the wages with effect from 30th/9. Okay, 30th/9/2015. So you have to pay an additional amount related to this period. Okay, additional amount related to this period. For this period, you have to pay based on new wages. Okay, new wages only in this period you have to pay. Okay, within this period only they had revised. This is the expenditure for period. So an different treatment will be required for an amount related to this period alone. Okay, a different treatment may be required for an amount related to this period. Okay, this will not meet the definition of prior period item because during 2015-16 year financial statements preparation there is no error or omission. This arrangement has only came into picture on 1/9/2016 after balance sheet date preparation. So this does not have any bearing on this. Okay, so this is not a prior period item. This will not be an extraordinary item. Why? Because this is wage payment. This is related to your ordinary activities. Okay, this is revision of wage. This is not an extraordinary. This is related to your business. So this is not an extraordinary item. Okay, this will be treated as an exceptional item. Okay, this will be treated as an exceptional item because when there is a retrospective revision in wages, this expenditure is not related to this period and this may be a huge amount also. Okay, if there is a 3 years a year, 4 years a year, this may be this may be a huge amount. If this is a material amount, if there is a material amount, if it is of such size, nature, or incidence that it is disclosed separately to understand the financial performance of this entity, then you can treat it as an exceptional item. So are you clear with this? Are you clear with this? If it is so material to this entity, then it needs to be treated as exceptional item. Clear? Clear? How it will not become an exceptional item, sorry, extraordinary item or prior period item. Is it clear? Is it clear? So we'll wind up today's session and we will continue with the standard tomorrow morning. That is changes in accounting estimate, changes in accounting policy. Those area we will cover tomorrow. Then we will be moving towards other standards also. Okay, so we will be having remaining apart from this 10 standards.